Okay, everybody. Hope everybody had a good weekend. I was traveling again this weekend, doing a 2-day training. I was the trainer, not the trainee. Saturday and Sunday out up in New Haven. Uh, Fall has definitely come upon us here in the Northeast. We thought we had skirted it for a while because it was in the 70s. Uh, I was in Providence the weekend before and down in College Park, Maryland, the weekend before that, and that's Saturday. Those have been Saturday and Sundays, but my training schedule now is back to Friday, Saturday. So I know that those of you who have been picking up the newsletter got a notice that it was going to be absent for a couple of weeks because of my travel schedule, but I will be in Chicago this weekend, doing a 2-day training on Friday and Saturday, coming home Saturday night. So there will be a newsletter produced Sunday for your consumption during the week. All right. Quick mention of the markets. I mean, look, we've kept talking about the market grinding higher, and it has been grinding higher. We had a couple of really strong days on the backs of some really good earnings news in the techs. Unfortunately, tonight, Priceline not reacting very well. I think it's down 100 points in the aftermarket. But the thing that still concerns me is that the market looks like it could be narrowing a bit. We're seeing actually Priceline is down $170 in the aftermarket. Anyway, you got to have the soldiers and the generals both marching onto the field, of battle in order for your army to win. You can't just have the generals leading the pack with nobody behind them. So we just keep our eyes on that and, see how it all plays out. But as always, we are individual. We're looking for individual opportunities that we think using the concepts that are presented in the course that give us good opportunities to create consistent results. We're not looking for home runs. So, in this portfolio, in this little trading account, which we have to call the educational trading account or the educational portfolio, because can't actually give recommendations, but we want to display the concepts. We've got about an 80% win rate with an average percentage win of close to 35%, and we've got about 9% losers or 10% losers. We got a scratch trade in there somewhere, but our average loser is only about 8% right now. That number is going to increase soon because we do have a couple of trades that unfortunately got away from us, but that's life in the big city. But if we stick to our knitting and we try not to panic and we use the skill set and we use the concepts of option pricing behavior as stocks move through time, we should be okay in the long run. Okay, so for the first few months that we've been doing this, July, August, September, the first 4 months or so, we've been focusing mostly on these diagonal trades. We've had a couple of put credit spreads, one in Amazon, one in the IBB. But for the most part, we've been doing these diagonals. And for the most part, they've all been called diagonals because we've been in a bull market. When that changes, obviously, we'll switch to the other side. And one of the great things about these diagonals, and I'll show you an example. Actually, I think I got a couple examples here. You can easily shift a bull call diagonal to something that has more of a bearish bias because of the law of equivalencies. So remember, buying a call spread is the same thing as selling a put spread and vice versa. So if we take it, well, I guess I get into it another time. Maybe we should run a special on that. But by moving the short strike from being above the long strike to being below the long strike, we actually change the trade from having a bullish bias, right? We're long the lower strike and we're short the higher strike. That's a bullish bias. To something that has a neutral to a bearish bias, meaning we're short the lower strike and we're long the higher strike. So for some of these stocks that haven't moved, you know, in our favor when we start with the call diagonal, if we can convert it or evolve it into something that has more of a bearish tone, we might actually not only improve our chances of breaking even or limiting the loss, we actually could turn it into chicken salad, if you know what I mean. So as those things happen, I'll be keeping you guys posted when we do these webinars. And now that I'm on back on track with my calendar, review some of these things in the newsletter. Okay, so first things first, you know, nothing like a little turmoil, you know, a bunch of princes in Saudi Arabia getting arrested to move the oil and the gold markets, but it didn't seem to hurt the equity markets. So there's still money coming into the stock market. But fortunately for us, this move in the oil market has really helped a couple of our trades. The big star here is this Whiting Petroleum December 5.5 call. This is one of, you will very rarely see me just buying calls. This was a stock that was priced low enough where doing any kind of spread didn't seem to be worth it to me. When I was doing the training class this weekend and teaching people about spreads, one of the things that came up that was very, very important that had to be said was, yeah, people like the idea of a spread because it's a hedge trade. But if you're going to do a spread where, in this, let's say a bull call spread, where you're buying a lower strike and you're selling a high strike, you better make sure that the amount of money you're getting paid for selling that short strike is worth it to you. Because remember, when you sell that strike, when you sell that call to somebody, you are literally selling to them the upside of that strike price. So you better make sure that when you collect that money for that short strike, you feel well compensated. It's not enough just to say, hey, I'm buying one call and I'm selling another. I saw some trades people were putting together in our workshop, you know, where they're getting piddly. They're getting nothing for selling that out of the money call. But they obviously, I taught them, you know, you buy the low strike, you sell the high strike. And then when we do the actual coaching, you know, the one-on-ones with the actual putting them on the, they get to put the trades together. You know, that's when I get back in front of the room and I say, hey, you know what? Don't just sell an out-of-the-money call for 30 cents or 25 cents because you're bringing in 25 or 30 cents. If that stock runs, you got paid very, very little for giving up the unlimited upside. So I just wanted to get that out there that, yes, spreading is great. But make sure that you feel you're getting fairly compensated for limiting the upside, okay? And that's especially true with not only with low price stocks, where the strike prices are a high percentage of the stock price, the distance between the strike prices. In other words, if you got a $6 stock and you got a $10 stock, and the strike prices are 50 cents apart, that's a 5%, right? Or if it's a $5 stock and they're 50 cents apart, that's 10% difference. So just make sure, that you're getting paid. The other way that you see this is when you get the low volatility, high dividend paying stocks. Call premiums are depressed. Why? Because call premiums take into account the cost of carry as well as the volatility. So we know a stock that has low levels of implied volatility is not going to carry high premiums relative to those stocks that carry high levels of implied volatility. But the option pricing model also takes into account the cost of carry, which is the interest rate, the risk-free rate minus the dividend rate. And in this environment, any stock that pays any kind of decent dividend is going to have a negative cost of carry. So if you took a stock that has low volatility and high dividends, you're not going to get paid very much for those out-of-the-money calls, right? Now, you're going to save money because the calls that you do buy are also going to reflect that. So, don't just go out there and sell calls or covered calls, just because it looks like, oh, I'm going to get 20 cents for this or 15 cents for this. There's a reason why that stuff is so low. Okay, so anyhow, so this Whiting Petroleum, getting back to this thing, the stock looked like it was turning around bullishly. So we picked up these, and I do have most of these trades are also in live accounts. So picked up this December 5.5 call here at 57 cents, and we're doing fine, right? Stock backed off a little bit, then it started going back up. Let me see if I can get the chart for us. That'll help everybody a little bit. Hang on a second. Let me get this chart. I'll bring it over. It's on my other screen. I'll bring it over as soon as it comes up, so you guys don't have to wait for it. All right. So here it's coming over. Special delivery. Here we go. Let me scroll out a little. Let me scroll out a little bit to make this a little smaller. Let me get that histogram out of the way. Right there. So, so here we have a classic rounding bottom against this resistance. Maybe you got a little reverse head and shoulders here, obviously in a very poor group. You could see the stock is getting what kicked out of it month after month after month. But we did come into this trade on September 20th. We picked up the December 5.5 calls for 57 cents. So let's go to September 20th, which should be around here somewhere. There, let's see, where are we? September 19th, September. There it is, somewhere in there, right in that area, right there. And why do we do that? Of course, because we had the breakout, the stocks moving above the moving averages. Stochastics now are solidly positive. PPO, the histogram on the MACD is good. Stock was just about to make a go a buy signal on the MACD signal line. The DMI, the directional indicator, which I do like, had also been positive for a while. Chicken money flow was improving. So there are a lot of good things going on here. So we picked up these 5.5 calls for 57 cents. Now we had to wait it out a little bit, right? The stock actually did move up originally, and of course initially, and of course felt like a genius. But that's one thing you have to try to temper, is stop with the self-congratulations, because as you know, anything could happen, because we are not in control of the market, and the market does not care about us. We only care about ourselves and each other. So the stock backed off, and now the stock started moving up solidly now in the uptrend. And of course, last night's news, or the weekend news, about what was going on in Saudi Arabia with the princes got people nervous, and the stock popped today. But we're still looking for a move, up into the $7.70, almost $8 area here. So I'm not really looking to sell anything right here, but I would like to use this as an educational opportunity to show you guys a technique of holding on to your entire position taking money off the table as a position management technique. Now, most of you are probably used to the thing of, hey, when my option doubles, I sell half and I play with the house's money, right? Well, the problem with that is, well, the good thing about it is that you have no more risk, right? The bad thing about it is you only have half your position, right? What if you could keep the entire position, take out most of your risk, and hopefully allow the thing will keep running if it's a call? How do you do that? The way you do that is by using a technique called rolling up. Okay? And the way you roll up is, let's get rid of this. We're long this. Okay? Number one, you stay in the expiration that you are currently in. There is no reason for you to move out to a longer term expiration if you still have time on this one, right? Why should I pay for this extra 35 days today? Why don't I wait until December and then figure out if I want to pay for the next 35 days? All right? That makes sense, right? It should make sense. Okay? So the first thing about rolling up calls is that you stay in the same expiration. Okay? The second part of rolling up is, the way you do it is, you really should wait until the delta of your option is getting close to 90, preferably 90 or above, because at that point you've wrung out a lot. You've wrung out the incremental. I don't know if I'm gonna say this right, but once you get up to the 90 delta, yes, you have 90 cents of delta if the stock moves up $1, but you also have a 90 delta if the stock moves down $1. So the technique of rolling up is to sell the option you're long and buy a higher strike. Okay, so you sell the option you're long, you buy a new option, okay, and you try to capture at least, and I always try to do this for more than this, at least 80% of the distance that you are moving the strike as the credit. So the amount of money you take out of the trade should be 80% of the distance between the option you own and the option you're going to. Okay? So there is some latitude there if you really want to take a lot of money off the table. But remember, whatever you're leaving on the table is going to be money that is increasing your break even by, even if it's just a little bit. So let me show you, and I was trying to work this out today. So we are long this call right here at 57 cents. Okay, 57 cents. What if I had been able to sell my 5.5 call, okay, right there, and buy the 6 call? Okay, now the difference between these strikes is 50 cents. So if I'm trying to get at least 80% of that distance, right, it'll be very hard with 39 days to go for me to sell a half-point spread for 50 cents, right, because there's time left. I mean, even up here, even using the mark, this spread isn't, this spread right here isn't even 50 cents, right? Right here, if you go this way and this way, right, that's barely 40 cents, okay? So what I was going to try to do is I was going to try to sell the option I own, buy the 6, and do it for a 40-cent credit. Okay, so if I did this for a 40-cent credit, what would my risk be? My risk is down to 17 cents. It's only 17 cents. Yes, I did not take all the money out of the trade. However, I am still long 100% of the calls that I originally purchased. The strike price is the 6, right? So if you think about it, right now, if I'm long the 6 call at 17 cents, and I started out with a 10 lot, I still have a 10 lot. And if the stock stays right here, let's say the stock goes to 717, okay, I'll make it easy. If the stock goes to 717, right, I'll make a buck, but I'll make a buck on 10 options, right? So I make $1,000. That's because I kept my entire position. Now, the other good thing about this is that what if the stock collapses and goes all the way back down, right? If it goes back down, I've only really increased, I only have a remaining risk of 17 cents. So from the point of view of being a trader, right, and you'll have to decide for yourself, but this is the way I like to look at things is, if I could keep 100% of my size and get the risk down to 17 cents and still be long an in-the-money call in a stock that's heading up, that's a good place for me to be. I would love to be in that spot. Okay? So this is a technique called rolling up. You get to keep 100% of the position, in other words, the size. Whatever strike price you go to, you want to try to capture at least 80% of that difference and take that off the table, leaving a small remaining risk, but 100% of your position. Okay? Now, let's just say I wanted to get a little more aggressive with the roll. Okay? We're still here at 57 cents. Okay? And I say, okay, I really want to take a lot of money off the table. Okay, so what would I do? I'll sell my 55, I'll sell my 5.5 call. Let's call it $1.70. Well, we'll use the mark here. So we'll use right in the middle. It won't be that fancy, right? $1.74, and I'll buy the 7 call instead. And the 7 call, let's say, would cost me that 75 cents. Okay, so if I went from the 5.5 call to the 7 call, okay, I'd raise my strike price for $1.50, right? By $1.50. The rule says you should capture 80%, the guideline, which means you really should do this roll for $1.20, right? Well, obviously this is not $1.20. This is 99 cents, right? 99 cents. Okay, but check this out. If I decided to do this, I would actually lock in a 42-cent profit, right, which is almost an 80% profit, right, on my original 57 cent cost, and I would own all my calls. I'd still have 100% of my original quantity, basically for nothing. It would just be a free ride on the 7s, right? So if you really thought the stock had the potential to keep going, and you didn't mind leaving, let's say, what's $1.50? You had 50 cents on the table, right? Because you're rolling up $1.50 for $1 credit, right? Fine, go have fun, right? But you could see that now you're at the 7 level instead of the 6 level, okay? Now, if you do the 6 and the stock keeps going up, then you could roll up to the 7, or maybe even up to the 8. So I'm not here to say the 80% is a hard and fast rule, because you might, once you know the technique, you can go there, you can go look and say, hey, this is a pretty cool deal. Right? I know Elliot said, you know, when you roll up, try to get 80%. But hey, here's an opportunity for me to take out, here's an opportunity for me to actually lock in a profit and still be long 100% of my original quantity. Forget about this half stuff, right? Forget about that half stuff. I want to keep this thing going, right? So from a trading standpoint, man, if something's going in my direction, I want to keep as many of my options. I want to keep my size as close to the original size as possible, right? Because if this thing keeps going, let's see, this thing goes to 9, then those 7 calls are going to be worth 2, right? And then that's another $200 per option. But I've already locked in 42 cents, so you know, hey, icing on the cake. Just love it. That's called rolling up. Okay, so keep that one in your back pocket. Okay, and hopefully we'll have a little more turmoil in the oil market tomorrow, and we'll see this thing move up even further, and maybe I'll be able to get that roll off for 80 cents. As it is now, you know, we paid 57 cents for the thing. And now it's trading at, we'll take the middle, $1.74. So what are we up? We're up $1.14. Oh, we got a triple. We got a triple on it, right? We got a triple. So we're up 200%. You know, that's good. That's way above our average, right? Because most of I said our average was what, about 35%. So if I actually close this out because I wanted to pad the returns, I could just throw this out and just say, hey, we made 200%. But you know, part of this is really a teaching vehicle. So I want to show you that there's ways to keep this thing going. Plus, we got over a month to go, right? And the chart ain't half bad at this point. It's really showing some serious strength here. As are, if you go through a lot of these oil stocks, you'll see. In fact, today I tried to put on a new position in Anadarko. That's got one of the best breakouts, I think, of the day. Again, solid stochastics, MACD on a buy signal from back here. Momentum is now positive. Directional indicator, Chaikin, is positive. Okay, I tried to do that, but it got away. So, you know, we already have representation. We've got enough representation in the oil patch to keep us busy for a while. So we don't have to really rush to put on that other trade. Okay, so that's the Whiting Petroleum. The Schlumberger, if you've been following me, this is just made me so happy today. Not that I have schadenfreude and I want to profit off of someone else's misery, but, you know, get those Saudi Arabian guys in prison and the oil market will go up, right? So this Schlumberger thing is a really cool thing, and I think I'll do it as a case study one day in the newsletter. Maybe I'll make a note to do this. We still got 2 weeks to go on this. Now, here's the deal. You see, we're only long the calls. The November 67 and a halves, but that's not how it started. Back on July 31st. Okay, so this to date, this will be the longest trade that we've had on time-wise. Okay, but sometimes you got to try to work it out. So we actually started this trade on July 31st, where we were long these calls, as you could see, at $3.40, but we sold the near-term 69 calls for 35 cents. So we started this trade off with a $3.05 cost. By selling, doing what I said about selling these calls, selling it down, right, moving the strike prices around, and also if you've been following the webinars, you know that before earnings, I actually bought a put spread just in case the earnings were bad, and that really helped because I bought the spread for 35 cents and sold it for $1.54. So our net exposure on those November 67 and a half calls is only 88 cents, down from $3.05. Okay? Now, today, there was a time where those calls were almost 90 cents. So, lo and behold, something that I had written off, that we were going to lose 88 cents, a little turmoil in the marketplace, and shaboom. All of a sudden, this thing is recalled to life. We got 2 weeks left, and if the market stays volatile to the upside like this thing could end up being a profitable trade. Now, the reason why I bring this one up is because this brings up another position management technique. We are clearly running out of time on this trade, right? So we might want to push this thing out another month. Okay, well, how do we do that? Well, one interesting way to actually attack this, let me go to Schlumberger, is to turn this, push the November 67.5 call out to a December 67.5 call, right? That would make sense, and give ourselves an extra month. However, if we sell this option for 80 cents and we buy this option for $1.44, that's not going to work, right? It's going to cost us 64 cents, right? Now, that's not bad because it actually gets our cost to, what is it? What did I say? 88 cents plus 64 cents is $1.50 something. So it's really, you know, we're only a few cents off, and we could do some diagonals against it. But here's the deal. The deal is that what you do, one thing you can do, not what you do, one thing you can do is sell twice as many of the 67.5 calls that you own and buy one, use that money to buy one of the December 15 67.5 calls, okay? So why don't we do this on paper, because we're going to end up right here in the little scratch area here, and let's see what actually happens. Remember, we now have a net cost of 88 cents on our 67.5 call for not this Friday but next Friday. Okay, if we sell, now this is a strange market because, you know, when the market closed, it's whatever the bid is that's posted. Okay, so we'll stick with that 80 cents. Okay, so let's say we sell 2 of these for 80 cents each. That's $1.60 credit. And we use that money to buy one of these, let's say for $1.45. Okay, so we sell 2 and we buy 1. That generates a 15-cent credit. Well, that 15 cents now comes out of this 88 cents that we have left and gets us down to a cost of only 73 cents. Now, for our 73 cents, what do we have? Well, we sold 2 of these. Okay, so if we start with 10, we sell 20 of what we own, but we only buy 10 of these. Well, doesn't that mean that we're naked? We don't want to be naked, right? What if the stock takes off, right? What if they arrest everybody in Saudi Arabia, right? The oil market will go crazy again, right? But that's not what happens. From that 20 lot, 10 of them cancel out, flatten out the 10 that were long. So we really end up only short a net 10 options. Well, if we're short 10 November 67.5s and we're long 10 December 67.5s, what do we have? We have a calendar spread. So let's model this calendar spread now at a 73-cent debit, because that's our now, at a 73-cent debit, because that's our cost, and let's see what it looks like. Okay, let's see if we like this thing. Okay, so we're going to sell the 67.5 call that we own. Right, we're selling twice as many, of course, but now it's only 1, and we're going to buy one of these 67.5 calls, but our net cost is only 73 cents. So we're going to change this debit now to 73 cents right there. And we're going to model this trade. So let's analyze the trade. We got to get rid of all these other things. Let's cancel out all these other things because I've been goofing around with different things in the last few days. So there we are. Now, we have a 73 cent net cost on this trade. Okay? So now we go out to November 17th, which is next week. Okay? And this blue line is our profit and loss for this trade, which is our new position, across all the different stock prices. Okay, now if the stock goes down, obviously, and we don't want to do anything, we don't want to turn it into a diagonal spread, and we will have 3 or 4 more weeks in order to do that. So the idea of taking out more premium still is there as a possibility. Okay, so if the stock goes way, way down, okay, we've only lost 73 cents. Remember, we started with this thing at 305. So losing 70 some odd cents of our original $3 cost is what, 20 something for 25% loss. Okay, that's lower than our average gain on our winners, which is cool, right? That's a good deal. Now, if we're lucky enough for the stock to close right at 67.5 on November 17th, then we'll make about 63 cents or so, which, believe me, given what we've gone through, is a pretty happy conclusion to this, because that'll be about a 21% return on our initial $3.05 cost, which obviously is way, way in the past. And again, this gets to the question of how do you calculate the return on capital, right? I do it in a conservative way for the profits, but because I'm consistent, it also helps with the losses, right? Because what I'm doing is I'm taking the final gain or loss money-wise and calculating it as a percentage of the initial capital, right? So as if I made money on a trade, let's say we make 60 cents on this, it's not fair for me to say, oh, we made 60 cents on 70 cents. That's not right, right? I can't tell you we made 90% on this trade because we didn't have 73 cents invested the whole time, right? If you go starting from 3 to 73, that's 373. If you divide it in half, that's $1.80. So, you know, if you wanted to play some games, you could find out what your average invested capital was over time, like a weighted return. How long did I have each risk amount at risk? How much time did I have each amount at risk as I lowered the cost, right? So from a return standpoint, the returns are very conservative, but on the losses, it actually helps, right? Because if I'm looking at an original cost of $3 and we only lost 73 cents, right? At the end, we do lose 100% of our final risk, which is 73 cents. But that's not really fair, right? So, because we didn't have 73 cents at risk the whole time. So we want to show the value of managing risk, right? So it lowers the percentage loss because we do that against the initial capital as well. Okay, so you'll have to figure out for yourself which way you want to go. But the point is, you know, if you did want to play around with a trade like this where you've managed it down and you wanted to push it out to an extra month, basically what this is saying is you could keep close to your initial risk. Actually, we took a little money off the table here. And you go out here, you really will still make some money. You'll make some money if the stock closes around 67.5. Now, what is the risk, right? Forget about the stock going down, right? The thing that hurts trades like this, right? If it's going down, we can always, you know, roll down and whatever, collect more premium. If it starts moving up, you know, that's where you got to scramble a little bit and hopefully be able to roll up this November 17, 67.5 call to the next week and the next week and the next week and the next week, right? For the diagonal spreader, that is the big boogeyman that's out there. Is something moves too far too fast, and then you start moving the strike prices around, and you can get a little whipsawed. Okay, but you know, for the number of times that actually happens, you know, you could count it on one hand or two hands. But I would say definitely not both hands and both feet, you know, during the year. So now that we've been doing this for a few months and we've had a chance to get a bunch of trades going, now hopefully you're starting to see some of the techniques that are available to you as you learn more and more about option price behavior, right? As I say to the classes, right, and I say to everybody out there, it's just math, right? It's just math. So if you have a tool that, like this tool, will create a picture of your adjusted trade, right? You can say, oh, I like it, I don't like it. Oh, okay. If you like it, go ahead and do it. If you don't like it, try to get another version of it, right? Try to create something else, a different scenario, and see if you like that. If you can't find anything, then you're going to have to make a decision, right? We do have to take responsibility in the end for what happens, right? So here we have Schlumberger at 67.10, bid in the aftermarket. Today's high was 67.42, so I think we're going to be okay. We'll see. You know, I don't wish anybody ill, but you know, a little turmoil in Saudi Arabia has been a good thing for us. So that's pretty much it from me today. As always, I appreciate your attention. I appreciate your interest in what we're doing here. And I'll see you guys on Wednesday. So good luck, everybody. Have a good couple of days. This is L.A. Catch signing off.